Hey there, everyone, and welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny Redmond, Washington. It's Tuesday, July 16th. Welcome to our new in-house recording studio. Hope it looks and sounds good to you. It certainly is a joy to be in this new space and be continuing to bring you some good market updates every weekday after the close as much as we can. Just a quick heads up, I'm going to be traveling to Boston to the Northeast, so traveling across the country tomorrow. So we won't have a show tomorrow, but we'll be back and better than ever on Thursday and Friday of this week. So thanks for your patience as we navigate around the country here. But what I want to share with you was navigating the current market environment. With that in mind, let's get to today's price action. As we're looking at the dashboard here on Stockcharts.com, you can see the S&P 500 up about 0.6%, a decent update. Now, what you'll note is the Dow is the leader today, right? So the Dow up about 1.9%, closing almost to 41,000 for the first time ever. Not quite getting above that benchmark, but certainly having a decent update. The S&P, of course, up 0.6% to around 5667. The NASDAQ composite did finish in the green. It spent a lot of the day actually below the zero line, but did finish up about 0.2% to just above 18,500. That's for the NASDAQ composite index. But look down here at mid caps up 2.5%, at small caps up 3.6%. That's the real story here, right? And we're so comfortable in recent months and certainly in recent years to think about technology and communication names, the mega cap growth names, the FANG stocks, the Magnificent Seven, whatever we want to call them, and then everything else. And now the everything else is what's really thriving here. Things like regional banks and industrial companies like Caterpillar, high dividend paying stocks that have not done particularly well in recent market history are all of a sudden starting to thrive quite a bit. As a matter of fact, the S&P 600 small cap index finished up over 3.5% today. So the NASDAQ up 0.2%, the small cap S&P 600 up 3.6%. So real difference between the other stuff and the mega cap growth. We're really seeing a rotation to those other things. Now, the VIX is remaining very low. So what would tell us this is a concerning topic kind of environment is the NASDAQ struggling to get further gains, weaker breadth because other names like in value-oriented sectors like industrials and materials not doing well, and the VIX starting to spike, which would indicate uncertainty. We're really not seeing that here. We're actually seeing volatility remain fairly muted, right? The VIX not much change from yesterday's close. So this is not mega cap tech struggling, and that's a bad sign for the market. This is mega cap tech not leading, but a bunch of other things are kind of stepping up to the plate and filling that void very quickly. I would be concerned when the VIX starts to spike. And again, we're not seeing that yet. So overall, this is sort of a things are just kind of fine type of environment. Looking at interest rates, you can see largely speaking, rates came down today. Bond prices were higher. The TLT was up about 1.4%. Bond yields in the form of the 10-year yield down quite a bit here. So finishing the day around 4.17. The long bond yield around 4.38. We'll look at the chart of the 10-year yield here in a few moments and just kind of check in on where things are at that way. In terms of this short-term pullback in the context of the longer-term pullback that we've experienced in interest rates. Commodity space kind of mixed here, but note that gold and silver were both in the on the positive side. Crude oil actually came down. Energy did not have a particularly strong day, as we'll see in a moment, but gold and silver did just great. Both of those ETFs, GLD and the SLV, both up about 2% for the day. Gold making new all-time highs today. Cryptocurrency is a little mixed as well. Bitcoin continuing to experience a nice rally after weakness over the weekend. Over the weekend, we got below 60,000. Now we're touching 65,000. We're just above there as we're recording the show just after the U.S. equity market close. So overall, looking just fine here. Looking at the 11 S&P sectors, you can see industrials number one, up 2.5%. Materials, the XLB, was number two, up 1.9%. And consumer discretionary, the XLY, is third in line, up 1.7%. Only one of the S&P sectors was down, but unfortunately, it's a big one and a growthy one. Technology, the XLK, actually finished down 0.3%. Communication services was second from the bottom, actually finished up 0.3%, about the same for energy. So, a lot of things outperform the S&P today. It's just sectors like industrials and materials, more value-oriented sectors that have not really been thought of as leadership names for quite some time. Speaking of mega cap leadership, or what we might start to call former mega cap leadership, or mega cap used to be leadership, you have Tesla with a decent day, up 1.6%. Apple and Amazon were essentially flat for the day, as was Netflix. But the real pain was down here. NVIDIA, one of the sort of perfect examples of the AI euphoria we experienced in the first half of 2024, really coming back to it today, down about 1.6%. Alphabet and Meta both down about 1.3 to 1.4% as well. Let's go to a daily chart of the S&P 500, and what you'll see is even though a lot of those leadership names were down, so many other things are working. And when that happens, there's enough positive performance in other areas of the market that's able to compensate for some of those technology names struggling quite a bit here, communication services and other growthy stocks. So the S&P 500 did make a new all-time high today, closing around 56.67. We remain in an overbought condition, which we've been in really since the 4th of July holiday. We've been overbought except for one day. So overall, this has been a pretty frothy market environment. As a trend follower, uptrends are not to be feared. They're not to be afraid of, right? We shouldn't be worried about the fact that the S&P keeps going up. We should be enjoying that, right? Let's pop the confetti cannons and just enjoy the fact that we keep making higher highs and higher lows. Get concerned when we don't make higher highs, when we don't make a higher low, when we break down through trendline support. And as you can see, we're nowhere near there at the moment, right? We've got plenty of space, plenty of daylight between where we're at today and that trend line, which has been drawn from the major lows over the last 10 to 12 months. So overall, I would say the condition, the situation, the layout of the market remains fairly strong. Now, you'll also notice when we look at the traditional Dow theory, like the Dow Industrials and Transports, had been looking kind of less confirmatory. It's looking a lot better here recently. What I call the New Dow theory, which uses the S&P 500 and the top panel and the NASDAQ composite, both pretty strong. Here's what I call the Newer Dow theory, which looks at equal-weighted S&P and an equal-weighted NASDAQ 100. Both of those made new all-time highs today. So when that is happening, when the different components, what we call the pillars of the markets, in this case, the S&P and the NASDAQ, both making new highs, this is a strong market, continuing to get stronger. Get nervous when one of these benchmarks makes a new high and the other one does not. That was the concern in sort of May, June, when you saw the equal-weighted NASDAQ kind of pushing higher and the equal-weighted S&P was not. But that divergence has been invalidated because we've now seen both of these break to new highs. So I would say Dow theory tells you that the conditions are relatively robust. Breadth remains very strong. And what was interesting in the first half of the year, particularly like out of the April low in sort of May into June, you saw breadth conditions get very weak. And here we see when the McClellan oscillator went below zero the third week in May, remained below zero for the entirety of the month of June. And that's as the market was going higher because this was a weaker breadth but stronger performance from those core growth names like Meta, Alphabet types of stocks. Those are doing well enough. Weaker breadth isn't a big deal. But now what we've seen going into July, big difference between this uptrend and the uptrend we're experiencing in July. June was a narrow advance led by a small number of mega cap growth stocks. July is more of a broad advance led by things other than those previous leadership names. So that's one of the outcomes after you have a strong period of outperformance for mega cap growth as other things step in and start to do well. And this chart sort of tells that story in the form of the McClellan oscillator looking at breadth conditions. Now, the breadth was negative enough here that it did trigger an initial sell signal from the Hindenburg omen, as we talked about, I think, on yesterday's show. So we're continuing to actively monitor that. No update yet. We'd have to get that indicator to a reset first. There are a bunch of stocks making new 52-week highs. And again, a different way of sort of visualizing or illustrating that advance that is becoming broader. A broader advance means more and more things are participating. And that's definitely what we're seeing here in mid-July. We had a record number, and not an all-time record, but certainly a record for the last couple months of stocks making new 52-week highs in the New York Stock Exchange, and also about the most that we've seen stocks making new 52-week high on the S&P 500. We don't have this updated for today's action just yet, but given what we've seen, I would anticipate a much higher reading on both of those indicators, telling you that a lot of stocks are going up, and that is what you really want to see in a bull market environment, is a bunch of things going up and continuing to drive performance to the upside. Let's take a look here quickly at small caps. I did show this version of this chart yesterday. I just want to show once again, right? Small caps continue to just absolutely thrive to the upside. And, this is more, I think, less about small caps are an interesting place to be. I mean, when you think about it, it's not just because the companies are small. It has to do with a couple different things. Number one, it has to do with how sensitive small cap stocks are going to be to interest rates, right? So if the Fed is expected to start cutting more quickly, which is sort of the vibe that you're getting in this market since the inflation data last Wednesday and Thursday, it's usually a better condition for small cap stocks because small cap companies are the ones probably borrowing a lot more money. Companies like Amazon don't need to borrow money. Microsoft, because they have a ton of it already, they have plenty of cash on hand to deploy for whatever they want. Smaller companies need to borrow money. So if rates are coming down, that's easier for them to grow. And that usually means that they're more interest rate sensitive along those lines. So small caps have popped. As I mentioned yesterday, they broke out of this symmetrical triangle pattern. But again, today, just continuing to push to the upside, up another 3+%. So small caps, if you're not there, I would encourage you to use our scanning engine. Look for the scooter rankings, right? Look for stocks in the top 10, 20% of their scooter rankings for the small cap space. Those are some of the tried and true trends that are starting to work. Scan for stocks showing buy signals from different technical indicators that you'd like to use, but focus in small caps because that's where you're seeing renewed strength where we have not seen strength in quite some time. I mentioned the interest rate situation. I do want to just quickly look at the 10-year yield here as we continue our market recap. I like to look at the 10-year yield this way, combining it with a couple indicators that really tell the story of how yields are related to kind of other things, right? At the top half of the chart, we're looking at the $TNX, which is the 10-year Treasury yield. This is an index that comes from the CBOE. It's $TNX. And if you've not used it on our platform and other platforms, this is quoted at 10 times the rate. So 41.67 means a 10-year yield of 4.167%. It's quoted that way because of the options that are traded on this index. And so it's quoted to make that conversion a little easier, but it's pretty, once you get used to it, it's not that hard to recognize what this is telling you. So this is saying at the end of the trading day today, 10-year yield was at 4.16, basically 4.16 or 4.17%. Now that is one of the lowest levels that we have certainly seen. You see we're at the lower end of this channel. If you start the clock at the April market low, the equity market low, you can see that off of those April lows, rates have been coming down. We have a clear pattern of lower highs and lower lows. We were above an upward sloping 50-day moving average and an upward sloping 200-day moving average here at the end of April. Now in mid-July, we're below a downward sloping 50-day and a downward sloping 200-day moving average. We're testing a new 3-month low here this week. So overall rates have been coming down. You can also see the shape of the yield curve, which is actually steepening a little bit. The yield curve has been inverted for quite some time because the short end of the curve is up above 5%. The medium end of the curve, I guess, for lack of a better term, that 10-year point, sort of down in the 4.25 range, and as a result, we have an inverted curve. But if the Fed starts lowering rates, that's lowering the short end of the curve. And if the long end of the curve even just remains about where it is, eventually you have a normal shaped yield curve, which tends to be really good for companies, particularly financial stocks, which is why a lot of the regional banks, which really make money based on the shape of the yield curve, are getting more and more excited, I would imagine, based on a more normalized shape to that curve, which makes their business probably a lot more profitable. So the other side effect of rates coming down are income-oriented stocks tend to do better, which means banks, REITs, utilities, consumer staples, those kinds of companies that tend to pay a higher than average dividend yield can be way more attractive when rates are coming down, because that means your savings account or a money market account or some sort of risk-free or low-risk account is not going to pay as much if rates are coming down. Those rates will be coming down as well. So something to keep in mind here as we pay attention to the performance of bonds as reflected by the 10-year Treasury yield. I want to look here next to the chart of gold. The GLD is where we'll start here. Two different ways you can kind of look at the chart of gold, and I tend to use them interchangeably because I think there are times when it makes sense for one or the other. I usually use the GLD. Full disclosure, I own the GLD in accounts that I manage, and it's been a pretty impressive run here over the last couple years, really coming off the October 22 low. The GLD is down here around 150, now around 230 here not too much later. So a nice overall upward trajectory, but the real story was the breakout in the first quarter. That breakout really pushed the GLD up above 220, 225, which has been resistance from April and May, just this week, the GLD is finally breaking to a new all-time high. Currently overbought, which again does not concern me a ton. That just means we're going up a lot. But note the range of the RSI, and I think this is fascinating, right? Look back mid-2023 as we're making lower lows and lower highs. Look at the entire range of the RSI bumps down a little bit. That's as we're making a downtrend phase of lower lows and lower highs. The momentum overall is weaker. Look at how that changed coming off the October 23 low. We start to make a pattern of higher highs and higher lows. The entire range of the RSI bumps up. We often become overbought on rallies. We rarely get below 40 on pullbacks. Overall, this is a momentum phase that is telling you we're more in a primary uptrend. So the fact that that pullback here in June remained above the May low and also the RSI remained above 40, that's just a beautiful illustration of the what's called the phase strategy with RSI. And credit to Connie Brown, who really popularized that strategy in her book Technical Analysis for the Trading Professional, and others as well that did some pioneering work on indicators and how to adjust them. Andrew, Andrew, I forget your last name. I'm so sorry. It'll come to me when I'm off camera probably, but also did some work with Connie along the lines of those indicators. All right, let's continue on then looking at some individual stocks just to finish off our market recap here. Dow members, I mean, if you look at the Dow Industrial Average, this has been the best performer out of the three, the Dow, the S&P, and the NASDAQ. One of the things I like to do on the dashboard is just switch the market movers. I usually have this at the S&P, and I'm often looking at just stocks that are up and down, just to give me some things to be aware of the big movers and recognizing the ones that are really maybe having an impact on the index. But you can also look at other indexes. So looking at the Dow, you can see UNH, up over about 6.5% today. Caterpillar up about 4.25% as well. Let's look at both of those two charts just to see what this means. Now, Unitedhealth, has really not been a particularly strong stock. I'm going to look at the unadjusted data here for a second. Underscore UNH for the last 2 years. I mean, if you look at this, for the last 2 years, the stock's gone nowhere. And that means you haven't lost money owning a UNH over the last 2 years. But the fact that the relative strength line has been going steadily lower is the story, right? Because that tells you that even though you haven't lost a lot of money on absolute terms owning UNH, you're underperforming the S&P because other things have just been much, much better. So UNH has been kind of a chronic underperformer because the price action has been flat. So while other sectors have thrived, this one's sort of remaining stagnant. Now, we're getting to the upper end of the range here and looking at the weekly chart. You can see how big of a base this is. So while today's move is great, and we're up about 7% for the week so far, look at this significant resistance level. It's around 550 to 560 from early 22, mid 22, late 23, and now once again, mid 24. We keep bumping against that same level. Ralph Acampora, one of my mentors, would often quote Alan Shaw, who said the broader the base, the higher in space. So the idea there is the longer we spend time within a consolidation phase, when we finally do break out what's called a big base breakout, that suggests much further upside on a name like this. So encouraging to see something like UNH potentially getting out of that base. I personally would be patient to see if and when a breakout could occur. Also want to bring up Caterpillar. Caterpillar having a nice day as well, up about 4%. And as you can see here, Andy Cardwell, by the way, I knew I would come up with it, but I was on camera. Andrew Cardwell. Andy, so sorry. Rest in peace, but thanks for your contribution to the Technical Analysis Toolkit for sure. He was the one who did some great work on RSI that I messed up the name earlier. All right, back to Caterpillar. You can see this classic downtrend, right? After you make the peak in April, lower peak in May, a low in April, a lower low in June. Now all of a sudden we're starting to break that. One of the great things about technical analysis, particularly just trendline analysis, is taking a trend, taking a move, and just drawing a simple trend line. This is, basically what I've done with the S&P 500 chart. Chart's going up, so I draw a trend line under the lows, and I'm just looking to see if and when we break below that trend line support. And that would tell me that, if nothing else, maybe something is changing, what we call a change of character. Look at what's happened in Caterpillar in the last week. We bounce off of support at 320. We break above the 50-day moving average. We break above a trend line using the peaks in April and in May. The RSI, instead of stalling out at 60, which is what happened at the May peak, we actually went right above 60, up above 70, which tells us overall the momentum is positive. So To wrap up today's final bar, I would say, stocks like UNH in healthcare, stocks like Caterpillar in the industrial sector, charts like Bank of America, to be honest with you. We talked about Goldman Sachs GS yesterday. Look at a Bank of America. This is a stock that has just bounced off of an ascending 50-day moving average 5 or 6 times over the last 6 months. So the playbook in 2024 has been wait for a pullback to an ascending 50-day moving average, wait for the RSI to bottom out just around the 40 level, and you've got a fantastic entry point to ride the next move higher. I'm encouraged by the performance I'm seeing in value. I'm encouraged by some of the dividend yields that you can still get on some of these top performing names. And as I mentioned recently, while growth stocks have been big winners recently, value stocks often can provide the double benefit of strong price performance, which we're now seeing, and a decent income component with the healthy dividend. You combine those two, powerful opportunity to outperform the S&P, which is what those last 3 names are certainly able to do. That's it for today's Final Bar. Thanks so much for joining us every weekday after the close. No show tomorrow on Wednesday the 17th, but we'll be back on Thursday and wish you guys the very best. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.